Yes, everyone. How are you all? I hope everyone is doing absolutely fine. I am also doing great. Today in this video, we'll be discussing the entire detailed solution of CA Final Financial Reporting exam, which was held in Jan 2026 attempt. But before we start, listen me carefully. This video is not about judging yourself. It is to know about the expectation of ICAI, so that you can analyze where you are standing right now and you can decide about your next move, next plan. In CA journey, what is very important? What is your next plan, what is your next move, and that can be decided when you have analyzed all your paper right now. And for that reason, I am here to give you the entire detailed solution for CA Final Financial Reporting paper. You can see already I have drafted the entire solution in one PDF. You can see on the screen the entire solution has been provided, including MCQs with reasoning. You can download this PDF from where? From my Telegram channel or WhatsApp channel. The link of this WhatsApp channel or Telegram channel is given in the description of this particular video. One important information that my previous Telegram channel, if you have already joined, that has been hacked. I do not have any access on my previous Telegram channel. To do join my new Telegram channel as well as my WhatsApp channel for all FR updates. Let us start the discussion. But before we start, if you are new to this channel, don't forget to subscribe to this channel and do like this video and share this video with all your friends. If this video genuinely help you to understand the entire solution, I'm targeting this time 200 likes, because that each like will inform you want more this type of video which will help you for your exam preparation. Now let us start with the MCQ part, then we'll move to descriptive part. To come to part 1 of question paper, and question number 1 is related to IND AS 115. What is given? A Limited and B Limited are enter in the manufacturing of homogeneous plastic bottle. Means can I say similar type of business? So what IND AS 115 says that if there is any non-monetary exchange between entities in the same type of business, to facilitate sales to the customer is outside the scope of IND AS 115, and therefore for such non-monetary transaction no revenue will be recognized even though fair value is given. Got this point? In this particular question, A Limited supply bottle to the customer of B Limited and B Limited supply bottle to the customer A Limited. Therefore no revenue recognized even though they have given fair value of 5 lakh and 5 lakh 20,000 respectively. Therefore the option number C is correct. No revenue should be recognized by either A or B for exchange despite a fair value of 5 lakh and 5 lakh 20,000 respectively, because IND AS 115 explicitly excludes such non-monetary exchange between entity in the same line of business conducted to facilitate customer sales. Now coming to question number 2, what is given? Let's see. It is given X Limited is reporting entity has a net investment foreign operation in its two foreign subsidiaries B Limited and C Limited. Of course, it is a question of IND AS 21. Loan made between group entities, that is settlement is neither planned nor likely to occur. Okay. X Limited with sterling means pound as functional currency is preparing its financial statement for the financial year ending 31st March 2025. It has a loan receivable of $1 million from its subsidiary C Limited that has been outstanding for some time. Can I say, even though this loan receivable is neither planned, the settlement is neither planned nor likely to occur in foreseeable future, can I say it will be a foreign currency monetary item in the standalone financial statement of X Limited, and therefore as per IND AS 21, it need to be translated by using closing exchange rate on reporting date, and any difference will be exchange gain or loss as the case may be, which will be transferred to profit and loss account. The parent notified the subsidiary at the beginning of financial year that no repayment of amount will be requested for the foreseeable future. The relevant exchange rate are as follow. You can see they have given on 31st March 2024, 1 pound is equal to 1.45 US dollar, and as on 31st March 2025, 1 pound is equal to 1.82 US dollar. Only one mistake what the student can do is that they have given exchange rate based on 1 pound in terms of dollar, and we need to convert $1 million into 1 pound. So when you are converting, what you will do? 1 million is 10 lakh. So 10 lakh dollar, we need to convert this into pound. So divide by 1.45. If you have multiplied, so it is quite possible you have got wrong answer. Here it will be 10 lakh divide by 1.82. Understood? Yes, sir. Determine the foreign exchange loss to be recognized in parent X Limited standalone financial statement as on 31st March 2025 with respect to loan receivable from subsidiary C Limited. So very simple. I hope you will get the answer. What is the answer given? Let's see. The value of loan as of 31st March 2024, it will be 10 lakh divided by 1.45. It will be 6 lakh 89,655 pound. And as on 31st March 2025, 10 lakh divided by 1.82, it will be 5 lakh 49,451 pound. Therefore, because the loan receivable is decreasing. Therefore, there will be an exchange loss. Exchange loss will be 1,40,204 pound. So option number B is correct. Option number B will be correct. Option number B is given. Okay, sir. Yes, sir. Come to MCQ number 3. You are a chartered accountant, have been approached by two partners of a firm who are in the process of dissolving their partnership. Okay. Both partners wish to engage you to assist with the financial aspect of dissolution. Which statement out of the following statement best describe the ethical concern in the situation and the code of ethics of the Institute of Chartered Accountants India? Option number C is correct. There is no doubt about this. This situation create a potential conflict of interest. Of course, there is a conflict of interest, and you may proceed only if the informed consent is obtained from both the party and appropriate safeguards are applied. So option number C is correct. Chalega. Now coming to case scenario number 1. Let's see. You are auditing Fortunate Limited for the financial year ended 31st March 2025. Fortunate Limited prepares financial statement on company's Indian Accounting Standard Rules 2015. The following information is available. Point number 1. On 1st April 2024, Fortunate Limited has issued 2-year mandatory convertible bond of rupees 20 lakh. So there is 2-year compulsory convertible bond. There is no transaction cost, and the terms require Fortunate Limited to make interest payment of 1 lakh each at the end of financial year 2024-25 and 2025-26. The bond will be mandatory converted into 10,000 ordinary shares on 31st March 2006. Can you see it is compulsory convertible? It will be converted into fixed number of equity shares. So can you say principal component will be classified as equity, and of course interest component will be liability component. Okay, sir. Okay. For this, what is the question given? Let's see. If the market interest rate for similar bond without conversion option is 9% per annum on initial recognition, then in the bond, can you say there will be a liability component? First, there is no equity component. This is wrong. There is no liability component. This is wrong. There is an equity component. There is a liability component. So can you say in this case, equity component will be more than liability component? Understood. Because principal component is classified as equity. Therefore, from my point of view, without calculation, you can see option number C. Option number C is the best option. But let us calculate it. So what I have done, you can see question number 4, reasoning. Interest payment 1 lakh annually for 2 years. Present value liability will be 1 lakh. Present value factor at a rate of 99% for 2 years will be 1,75,910. Therefore, equity component will be how much? Equity component will be 20 lakh minus liability component, that is 18,24,090. Therefore, the value of equity component will be option number C is correct. Without calculation also you can do if you have some analytical mind. Coming to next para, what is given? Point number 2. On 1st October 2024, Fortunate Limited has issued 5-year 9% per annum optionally convertible debenture of 4 crore. Now, optionally convertible debenture. The OCDs are convertible into ordinary shares of Fortunate Limited at the option of holder. At the end of the tenure of 5 years in the ratio 1:1 each. Each OCD will be converted to 1 ordinary shares, interest paid annually on 30th September each year. On 30th September each year. The market rate for the issuance of OCD without conversion option is 12% per annum. The market rate of interest is given 12% per annum. Of course, let's see what they have asked in this question. With the respect to OCD, the finance cost to be charged to SOPL for the year ended 31st March 2025. You can see it was issued during which year? On 1st October 2024. It means you need to calculate interest only for 6 months by applying EIR. By applying EIR. So of course, first you need to find out liability component. Now for liability component, first we need to calculate contractual cash outflow, that is interest component and principal component. Okay, interest component will be calculated by applying contractual rate of interest. Contractual rate of interest is how much? 9% will be applied on 400 lakh, which will be 36 lakh, which will be paid for how many years? 5 years. And the principal component will be how much? 400 lakh, because it is optionally convertible debenture. Can I say principal component will be initially classified liability, and of course it is redeemable at par. Therefore, we'll take 400 lakh. Okay, this 36 lakh will multiply with the annuity factor at market rate of interest, which is given how much? 12% per annum for 5 years. And this 400 lakh will multiply with the present value factor at 12% at the end of 5th year. So of course you can calculate it, you can find out liability component. Once you got a liability component, that become opening liability, multiply with the effective rate of interest. There is no transaction cost given the question. Therefore, effective rate of interest and market rate of interest will be same. So multiply with the effective rate of interest, that is 12% for how many months? 6 months. You will get finance cost. So of course you can easily calculate. Now the solution is given. What is given? Check karo. Initial liability will be present value of interest 36 lakh multiplied by annuity factor for 5 years, and the present value principal component, that is 400 lakh, multiply by present value factor at 12% at the end of 5th year, the answer will be 356.73 lakh. Now 356.73 lakh multiply by market rate of interest for 6 months, 6 by 12. So opening liability multiply by year for 6 by 12, your answer will be 21.40. This will be finance cost charged to profit and loss account. So what is your answer? Option number D is correct. Option number D is correct. Okay, sir. Now next point number 3, what they have given, Fortunate Limited had issued 2 lakh 5% per annum loan bond on 1st April 2023. The issue cost was how much? 8,000. The transaction cost is given, which is deducted from the initial proceed. Therefore, initial liability will be 1,92,000. These bonds are redeemable at premium, hence the effective rate of interest given 8% per annum. Let's see what they have asked. They have asked you to calculate with respect to loan bond of rupees 2 lakh, the finance cost to be charged in SOPL for the year ended 31st March 2025. So can you see it will be at the end of second year because it was issued at the beginning of 1st April 2023. Got this point? So of course you can calculate the amortized cost for the first year by applying EIR. Then on that amortized cost, that we need to apply what? Effective rate of interest, you'll get the finance cost. Answer is already calculated. Let's see. So initial carrying amount will be 1,92,000. Year 1, 1,92,000. 8% is what? 1,15,360. Contractual interest paid at a rate of 5% 10,000. Therefore, amortized cost will be how much? 1,92,000 plus 15,360 minus 10,000. This is the amortized cost at the end of first year. Now, on this, apply what? Effective rate of interest, that is 8%. You'll get the finance cost charged to profit and loss account at the end of second year, that is 15,789. What is the option given? Check. The option is what? 15,789 means option number A is correct. Chalega. Okay. Now let us come to case scenario 2. You have recently qualified as a chartered accountant and being recruited by Star Limited. Okay, sir. You are being interviewed by CFO of the company. You are provided with the following situation. So your interview is going on. Point number 1. Star Limited act as a mediator between a lessee and a lessor, wherein the lessee has taken commercial property on lease from the lessor. Okay. As per the lease agreement, the rent will be paid by the lessee to Star Limited, and Star Limited will then pay the rent to the lessor. Let's see what is the MCQ for this. So in respect of lease transaction, choose the most appropriate option in preparation statement of cash flow. Can you see in this case, in statement of cash flow for Star Limited, the rent is first paid to Star Limited and then Star Limited will pay to the lessor. So can you see they can report this particular transaction as a net amount, So as per IND AS 7, the transaction may be reported means one option has been given, may be reported on a net basis. This is an option given, not must. It is may be reported on net basis. So option number C is correct. So for 7, you can see what I have given. Option number C is correct. It may be, not must, it may be reported on net basis. Okay, sir. So I hope here the student might be confused with may or must. So you have given option number D, then it will be wrong. Option number C is correct. Option number C is correct. Next point, come to point number 2. Star Limited had on 1st April 2024 purchased a machine for 110 lakh. The useful life of the machinery is 10 years and the residual value is estimated to be 10 lakh. Okay. The machine is depreciated with straight line method. On 31st March 2025, means at the end of first year, a test for impairment was conducted with respect to the aforesaid machine. The fair value less cost to sell is 82 lakh and the value in use is 72 lakh. So one thing is clear, recoverable amount is 82 lakh. Now only we need to find out carrying amount. Carrying amount will be calculated by calculating depreciation. Depreciation of first will be 110 minus 10, 100 divided by 10. So 10 lakh is what? The depreciation. Therefore, the carrying amount at the end of first year will be 110 minus 10, that is 100. 100 minus 82. 100 minus 82. What is the impairment loss? 100 minus 82. Impairment loss is 80. Let's see what they have asked. With respect to machine purchase on 1st April 2024, determine the impairment loss as per IND AS 36 to be recognized in the financial statement financial year of 2024-25. So of course 18 is impairment loss. You can see either option number A or option number D. So they have asked one more question. And depreciation as per IND AS 60 in the financial year 25-26, in the next year, assuming the revised residual value is now 1 lakh. Revised residual value is now 1 lakh. So can you see it will be 82 minus 1 and the remaining useful life is 9. So 82 minus 1 divided by 9, it will be 9. So option number A is correct. Option number A. Option number D is not correct. Option number A is correct. Let's see what is our answer. So you can see we have given option number correct option as a calculation is given. You can check it. Okay, this is also done. Now coming to Next point, point number 3. Star Limited had incurred following expenditure for the development of its first and only software product customized to Indian environment, which is to be offered to the Indian customer. The development commenced on 1st April 2024, ended on 31st December 2024. So ended on 31st December means it was the date when it was available for use, when the software was ready for sale. However, the first sale of the product was made on 1st April 2025. This is not at all relevant. The following information is made available to you. The purchase price of imported software, it will be capitalized. Direct employment cost of software for the full financial year, but Kenis will not take full financial year, will take only 9 months. So we'll do 9 by 12. So 3600 into 9 divided by 12, it will be 2700. So we'll take only 2700. Yes, sir. Testing cost will be capitalized. Other costs directly related to customization, which include an abnormal cost of 15 lakh in respect of repairing the damage as a result of security breach. So of course, 15 lakh will not be considered. So minus 15 will do. So 1350 minus 15, it will be 1335. Okay, sir. Professional fee paid to the external software developer will be capitalized. Cost of training provided to sales staff will not be capitalized. Cost of marketing will not be capitalized. Admin and general overhead will not be capitalized. So this become the, if you add whatever I have said, then you will get what? The cost price. What is the question? The total cost as per Ind AS 30. Super easy. Let's see what is our calculation. You can see we have done that only 1800. Then for 9 months 2700. Then 5400 testing cost. Then after abnormal loss it is 1335. Then it becomes professional fee 660. Answer is what? 11895, 11895. So option number C is correct. Option number C is correct. Okay, done. Yes, sir. What is the next point? Check. Point number 4. In this, many doubt came. What is the doubt? Let's see. The Star Limited has certain cases pending before various forum under different law. The following table is a summary of such pending case. You can see filed by employee, filed by customer, filed by vendor, filed against vendor. Number of case, outcome, probability. You can see here the outcome is either loss or gain. So there is two possible outcome. There is a two possible outcome of each case. So whenever there is a two possible outcome, we always apply most likely outcome method. Means in this case, weighted average method means expected value method should not be considered. Are you able to understand? So in this case, if you have applied weighted average of all possible outcome, your answer might be different. But if you apply most likely outcome method, your answer will be different. From my point of view, it should be most likely outcome method. It will be 2 lakh provision should be created for each case, and 1 lakh in this case provision should be created for each case, because in this case the probability means the chances of loss is probable. But can you see in this case, yes, it is 50%, but extremely difficult to make reliable estimate. Therefore, no provision will be recognized. It can be disclosed as a contingent liability. In this case, there is a high chances of winning, and therefore it will become a contingent asset. Therefore, your answer is what? 28 into 2. 28 into 2, that is 30. 28 into 2, that is 56, and 12 into 1 is 12, means your answer is 68 lakh. Your answer will be 68 lakh. What is the multiple option given? You can see 68 lakh. So option number B is correct. As per Ind AS 31, company should recognize the provision in its financial statement with respect to pending legal matter. Option number B, from my point of view, option number B is the best answer. Okay, sir. However, we need to wait for the ICAI. They can also apply expected value method, but from my point of view, option number B is more appropriate. Okay, now let us come to case scenario number 3. The following information of H Limited, which regularly prepares financial statement as per Ind AS, is given. Point number 1, the share capital of H Limited since its incorporation is 1 lakh divided into 10,000 ordinary shares or rupees shares. There are how many shares? 10,000. The company on 1st June 2024 issued 3,600 compulsory convertible debenture of rupees 10 each. So they have issued 3,600 compulsory convertible debenture. At the end of 11 months, TCD will be converted into ordinary shares in the ratio of 1 shares for 6 CD. Means 6 debentures will be converted into 1 share. And you can see the debentures were outstanding for how many months? So from 1st June, April, May means for 10 months. It was outstanding for 10 months. So what is the multiple choice question? Let's see what they have asked for these. Yeah, choose the most appropriate option for calculating earning per share for H Limited. Means what is the denominator for basic and what is the denominator for basic earning per share? What is the denominator for diluted earning per share? They have asked. So can you say for basic earning per share it will be 10,000. There is no doubt. So can you say either option number A is correct or option number D is correct. But we need to also think about diluted earning per share. For diluted earning per share they have given There were 3,600 debentures and it will be convertible. 6 debenture will be converted into 1 equity share, so 1 by 6. So 3,600 divided by 6, it will be 600. And it was outstanding for how many months? 10 months. Into 10 divided by 12, so it will be coming 500. So for this year, there is how many potential equity share? 500 potential equity share. So the denominator for diluted earnings per share will be 10,000 plus 500. So 10,000 plus 500. So however, this option number A is correct. Option number A will be correct. Okay, sir. What is our answer? Check karo. So option number A is only correct in our PDF. Understood? Yes, sir. Come to the next point. What they have asked. H Limited on 1st April 2024 acquired 40% of ordinary share capital of C Limited at a cash consideration of 1,95,000 when the carrying value of net asset of C Limited is 3 lakh and the fair value was 4 lakh. So net asset was 3 lakh and the fair value is 4 lakh. This is relevant. The excess of fair value over carrying amount was attributable to one of the building owned by C Limited having a remaining useful life of 10 years with no residual value. So of course, can I say there will be some fair value depreciation adjustment also. C Limited after taxes earned profit of 80,000 and other comprehensive income of 20,000 during the financial year 24-25. So what they have asked? Let's see. The amount of goodwill. First question is the amount of goodwill. The amount of goodwill will be very easy. What is the cost price? Cost price is 1,95,000. Fair value is given 4 lakh. 4 lakh into 40% how much? It is 1,60,000. So 1,95,000 minus 1,60,000, that is 35,000. The amount of goodwill will be 35,000. That is only correct. It is option number D is correct. Option number D. You can see in our PDF option number D is correct. Then next question related to this only. The share of H Limited in the profit and other comprehensive income. So what is the total profit given? 80,000. But can you see it will be adjusted with the fair value depreciation, and the fair value depreciation will be 1 lakh is the fair value gain divided by 10. So 10,000. So we'll do minus 10,000. Minus 10,000 it is 70,000. 70,000. What is the percentage? I forgot. It was how much percentage? 40%. So into 40%, so 70,000 into 40%, how much? 28,000. And other comprehensive income, how much given? Other comprehensive income they have given, how much? 20,000. 20,000 ka 40%, 20,000 ka 40%, that will be how much? 8,000. So option number B is correct. Option number B. I think here student might have done mistake if they have not deducted fair value depreciation from the profit earned during the year. Here, quite possible you have done this mistake. So 13B is correct. Let's see. What is our answer? 13B is correct. Okay, yes, sir. Next point. Next point related to that para only. The amount of H Limited closing balance of investment C Limited to it was acquired at what amount? The cost price of investment was how much? 1,95,000. So 1,95,000 plus 28,000 plus 8,000. This will be your answer. So 1,95,000 plus 28 plus 8. It will be 231, means 2.31 lakh. So option number C will be correct. Let's see in our PDF what is the answer given. Option number C is given as correct. Okay, 14 done. Now coming to 15, the last MCQ of this particular paper. The cost should this. I need to read the para first. H Limited is also required to publish quarterly information. Some of the expenses are however incurred on an uneven basis. It is a question of IND AS 34 interim financial reporting. For the financial year 24-25, the entire advertisement cost of 30 lakh is on one bullet payment was incurred on 1st August 2024. So can you say any advertisement cost cannot be deferred, cannot be anticipated. It will be charged to the PL of that interim period in which it is incurred. So this 30 lakh will be entirely charged for the relevant interim period. Okay. Bonus to sales staff paid at year end was budgeted to 40 lakh for the entire year, out of which 8 lakh relate to the quarter ending 30th September 2024. So can you see in this case, the bonus to staff will be 8 lakh for the relevant interim period. Therefore, 8 lakh will be charged to the quarter ending 30th September 2024 because it can be anticipated, it can be deferred at the end of financial year also. Okay, sir. Chalega. So which option is correct? If you come to question 15, the cost that should have been included in the interim financial result of H Limited for the quarter ended 30th September 2024. So 30 lakh advertisement cost and 8 lakh bonus staff will be charged to that particular interim period. So option number D is correct. Okay, sir. Option number D. Come to our PDF. Option number D is correct. With this, we completed the entire MCQ question discussion. I hope you have understood all the part. Now the next, we'll discuss what descriptive part. Now let us come to the descriptive part, starting with the question number 1 of part 2, which was related to consolidation chapter. As usual, mandatory question. Okay, good question. Similar question we have in our study material, ICAI study material, as well as in our question bank. Past year also they have asked same question, but in this time they have added some more information. If you have understood that information, the question was very easy. If you have not understood, of course some mistake you have done. Correct? Let's check whether you have done some mistake or not. Okay, but good question. It was simple. You could have handled this question by your own. On 1st April 2024, A Limited acquired 80% of equity share capital of S Limited. On the said that the share capital and other equity represented entirely by retained earning of S Limited were 10 lakh and 2.5 lakh respectively. Means they have given retained earning on the date of acquisition of S Limited. To the selling shareholders, A Limited paid initial cash consideration of 20 lakh, issued fresh 4 lakh equity shares of nominal value of rupees 1 per share at a current market price of rupees 2 per share. Of course, it means fair value of equity shares issued will be 8 lakh. Agreed to pay a further 6 lakh after 3 years, that is on 31st March 2027. It becomes deferred consideration. Deferred consideration will be calculated, measured at present value. For that, they have given cost of capital 10%. They have given discounting factor that will multiply by 0.75. So 6 lakh into 0.75, and we can easily calculate purchase consideration. Both A Limited and S Limited prepare their financial statement as per Indian accounting standard. Their balance sheet is given. You can see in the balance sheet investment is coming only at 20 lakh. It means they have recorded only cash consideration till now. Fair value of equity shares issued and fair value of deferred consideration not recorded. So of course, this need to be recorded while preparing consolidated financial statement. The following additional information provided since its incorporation, S Limited has been selling some of its product under the brand name Bliss. At the acquisition date, A Limited valued this brand at 8 lakh with the remaining useful life of 10 years with nil residual value. A Limited amortized its intangible asset on a straight line method. The brand is not recognized in S Limited balance sheet. Even though brand was not recognized in acquiring company books, it can be recognized in the books of acquirer at fair value on the date of acquisition. So fair value 8 lakh will be considered on the date of acquisition, and of course, can I say during post acquisition period there will be one additional amortization adjustment. Okay sir, yes sir. As the 31st March 2025, goodwill recognized on consolidation is to be impaired by 25%. So whatever goodwill was calculated on the date of acquisition will be impaired by 25%. A Limited group measure NCI at fair value. Fair value method will be used for NCI. Equity shares of S Limited were quoted at 4 rupees per share on the date of acquisition to find out NCI at fair value. Immediately after acquisition, this was, I will say, a good point, which was for the first time they have asked in a full consolidation question. Of course, we have a separate question on this, but in the full consolidation question, they have asked for the first time. So if you have not understood this particular para, you might have done some mistake in calculation of what? Either analysis of profit of subsidiary company or in the retained earning. Quite possible. Immediately after acquisition, that is on 1st April 2024, A Limited, which also sold capital equipment costing rupees 4 lakh to S Limited at 5 lakh. You can see this become inventory of A Limited. So on that there will be unrealized profit of rupees 1 lakh, which will be eliminated from the books of parent company. Okay, means what journal entry you'll do? You'll do retain earning account debit to stock, retain earning account debit to inventory. This capital equipment is recorded as PP by S Limited. So in the books of S Limited it become PP because it is property, plant and equipment. So can I say S Limited started charging depreciation on that, and depreciation was also calculated on that profit portion. So if you are eliminating profit, you need to also eliminate the excess depreciation which has been charged by S Limited in their books of account. And if you eliminate, can I say profit of subsidiary company will be increased. Therefore, one more adjustment entry will be there. That what adjustment entry you'll do? PP. What adjustment entry you'll do? PP account debit to profit of subsidiary company, means AOP analysis of profit will be also affected. Okay. The useful life of the equipment on the date of transfer was 10 years with nil residual value. This information has been given to calculate that excess depreciation already charged by S Limited. The equipment is depreciated on a straight line method. Good point. I was expecting this, that some attempt they will pakka ask this particular point. I have said many times in the class also that we are expecting this type of information in exam, and now they have asked. Means now institute is adding always some new point which is not yet asked anytime in previous attempt. Got this point? Yes sir. A Limited is yet to record issue of shares and deferred consideration in their books of account. Already I have said you are required to prepare CBS. This is the entire question. Question was, I will say, manageable. If you can handle this point, it was a manageable question. Okay. let us come to the solution. So what we have done, first working out basic information. What is the date of acquisition? What is the date of consolidation? Holding, of course, 80%, A limited, NCI 20%. This is the basic information. First, we need to calculate PC because purchase consideration is not given. So cash payment is 20 lakh. Unrecorded consideration, fair value of shares issued will be 4 lakh into 2, that is 8 lakh. And deferred consideration will be 6 lakh into 0.75, that will be 4.5. And this will be the total purchase consideration. Okay, total purchase consideration. But out of that, what is not recorded? This is not recorded, this is not recorded. For that, we need to pass one journal entry in the standalone financial statement of what? Of parent company. So investment account debit, equity share capital, 2 securities premium, 2 deferred liability. By what amount? It is 8 plus 4.5, that is 12.5. Your investment will increase by 12.5, and then your equity share capital will increase by 4, securities premium will increase by 4, and deferred liability will increase by 4.5 on the date of acquisition. On the date of acquisition. Yes, sir. Yes, sir. Then analysis of net asset. We'll do analysis of net asset. Of course, in this particular whatever working I have given, there is only one adjustment it to be done in the AOP of subsidiary company. AOP of subsidiary company, analysis of profit of subsidiary company, that is about that excess depreciation. So what I have done, instead of preparing AOP, I have given direct effect of that adjustment in retained earning NCI. You could also, what you can do that adjustment in AOP. Then the net effect will be given in what? Your statement of net asset. Okay, yes sir. So directly I prepare statement of net asset at acquisition, post acquisition, at reporting date, share capital as per the information given the balance of subsidiary company, and you can see the closing balance of retained earning. The closing balance of retained earning, how much given? You can see this given 6 lakh, and they have given opening retained earning how much? 2.5 lakh at the beginning of the question. So what we have done, 6 lakh, then 2.5 lakh. This is a post acquisition profit. With this you can adjust that excess depreciation right now here only. But I have done direct effect. You could have also prepared analysis of profit. That is your choice. Okay. Now in this we'll do fair value adjustment. Fair value adjustment directly can be done. So there is a fair value gain in the brand of 8 lakh on the date of acquisition. So your net asset on the date of acquisition will increase by 8 lakh, but for this we will have some post acquisition amortization also. That will be 8 lakh divided by 10, that is 0.80. So 0.80 will be deducted with the post acquisition profit, and this will be the net asset on the date of acquisition. This will be post acquisition profit. Okay sir? Yes sir. Chalega. Then working note number, next working note 4 will be goodwill calculation. For that PC already we calculated 32.5. Now what we'll do, we'll calculate NCI at fair value. NCI at fair value what? Total number of shares, it is given 10 lakh. Total number of shares in the books of subsidiary company, because the face value is ₹1, so 10 lakh will be the total number of shares. Multiply by 20%, means 2 lakh is the shares, and the fair value of shares of subsidiary company is given 4 lakh. So 2 lakh into 4 is equal to 8 lakh is the fair value of NCI. Total become 40.5, and the fair value of net asset on the date of acquisition is 20.5. Already we calculated. So this will be the total goodwill. Total goodwill will be how much? 20. Out of that, 25% impaired. So 5 will be impaired, and the goodwill on the date of consolidation will be 15 lakh, which will appear in the balance sheet. Because it is full goodwill. Why it is full goodwill? Because NCI is measured at fair value. This impairment loss will be allocated both to parent company NCI when we'll do the calculation of retained earning and NCI. This adjustment will be also required. Then can I say we'll also do one working for unrealized profit on equipment. You can see A limited sold equipment costing ₹4 for ₹5. Unrealized profit to be eliminated is 1 lakh, correct? And S limited charge depreciation on what? 5 lakh. So excess depreciation to be reversed will be what? 5 lakh minus 4 lakh divided by 10, means you can say 1 divided by 10, 0.10. So what will be the adjustment entry for this? What will be the adjustment entry for this? We need to eliminate retained earning by 1 lakh and profit of subsidiary by 0.10 and PP by how much? 0.90. This will be what? Your adjustment entry. This will be adjustment entry. Retained earning will be reduced by 1 lakh. Profit of subsidiary company will be increased by 0.10. Either you can do adjustment in the post acquisition profit, or what you can do, because already we calculated post acquisition profit, directly it will be allocated retained earning NCI in 80% and 20%. That direct adjustment also you can do. Okay, and PP will decrease by 0.90. Understood? Yes sir. Then can I say one working note we'll do for deferred consideration liability. What was deferred liability on the date of acquisition? It was 4.5 lakh. Can I say on that we need to calculate finance cost for the 1 year, because of course on that interest will be added. Interest will be added. So 10% is the discounting rate. So that will be interest interest will be 0.45. Therefore, deferred liability as on the date of consolidation will be 4.95. Correct? So this finance cost will be the interest expense of parent company will be charged to retain earning while preparing retain earning calculation. Okay, yes sir. Then consolidated retain earning, you can see balance as per the balance sheet of A Limited, it is given 15 lakh. Then unrecorded finance cost 0.5 lakh, 45 lakh, 0.45 lakh. Then share in excess depreciation reversal on annualized profit. Excess depreciation reversal. So 0.10 into 80%, 0.08. The 20% will be adjusted with what? 20% will be adjusted with NCI. Okay, sir. Then less annualized profit on downstream sale. It is 1 lakh will be eliminated. Yes, sir. Then parent share of goodwill impairment will be 4 lakh. 5 lakh into 80%. 5 lakh into 80% because 20% belong to NCI. Okay. Then we have to add share in post acquisition profit. What was the post acquisition profit? We calculated 2.70 as per statement net asset. Let's see what we calculated. 2.70 into 80%, how much? That is 2.16. So consolidated retained earnings is 11.79. Now let us come to NCI calculation. NCI on the date of acquisition, what? 8 lakh already calculated. In this we'll add what? Share in profit of subsidiary company, that is 20% 2.70. Then impairment loss will be deducted. 1 lakh will be deducted. And then share in excess depreciation reversal will be added, that is 0.10 into 20%, that will be added. This will be NCI on the date of consolidation. Now you can prepare the balance sheet. Balance sheet of course you can do. I am not writing the balance. I am not explaining the balance sheet. You can understand balance sheet by your own. I hope you understood this point. Have you understood entire calculation? You understood? Bol chalega? Okay, yes sir. Okay. In this equity share capital, be careful. Equity share capital will what? Whatever is given in A Limited balance sheet plus can I say we will also do 4 lakh shares which was issued additionally for PC. So 4 lakh into 1 will come and 4 lakh into 1 will go to securities premium under other equity. You can see in securities premium under the head other equity we have also added 4 lakh. Okay sir, this you can manage. So this was question number 1. I hope question number 1 is clear. Now come to question number 2. Question number 2a, it is related to IND AS 109. Similar question we have in ICAI study material, same to same question they have already asked in our previous attempt also. Let us read. Jibra Limited is considering to grant an interest-free loan of rupees 25 lakh to its wholly owned Indian subsidiary company Camel Limited. No transaction cost is attached with the loan, so it is a interest-free loan. So of course contractual rate of interest will be 0% and there is no transaction cost. With respect to other terms and conditions, the following alternative options are being considered. They have given 3 options. We need to give accounting treatment based on 3 options. Option number 1, what they have given? The loan is an interest-free and is repayable on demand. So whenever there is a loan which is repayable on demand, in that case the fair value of financial asset will be equal to whatever transaction price has been paid. Similar case will be applicable in the books of Camel Limited, means the fair value of financial liability will be transaction price received and will not apply any amortized cost method to calculate interest income or interest expense in their respective books. It is very simple. I hope you have understood. Option number 2, the loan is an interest free and is repayable in a single bullet payment after 4 years from date of granting such loan. The current market rate of interest for similar loan is 12% per annum. So can you see in this case it is at off market terms. The financial asset will be measured at fair value. Fair value will be equal to present value of contracts or cash inflow discounted at market rate of interest. Of course you can calculate it. Means in the books of Jibra Limited, what journal entry will do? Financial asset account debit, and the difference between fair value loan and transaction price paid will be considered as investment in equity instrument of subsidiary company. So investment in equity instrument of subsidiary company to bank. In the books of Camel Limited, can you see it will be financial liability. So bank account debit to financial liability, and whatever difference between fair value and transaction price, that will be equity instrument, and that will be to capital contribution from parent company. Got this point? Yes sir. And then we can recognize interest income, interest expense in their respective books by applying effective rate of interest. Because there is no transaction cost, effective rate of interest will be equal to market rate of interest, that is 12%. Of course calculation you can do. The solution is given, you can check. Option number 3, the said loan is an interest free and will be repaid as and when Camel Limited has fund to repay the loan amount. Now in this case just try to understand, in the books of Camel Limited it will be considered as financial liability because there is some contingency regarding payment. Whenever there is a contingency regarding payment, whatever transaction price has been received, that will not be equity, that will be what? Considered as financial liability. Okay. Now in this option number 3, you can see the repayment date is not given. The The settlement date is not given. Therefore, we need to estimate the settlement date. And if you estimate that settlement date will be 4 years, therefore the solution of option number 3 will be similar to option number 2. Okay, sir. You are required to suggest as per applicable Ind AS under each of the option the accounting treatment of the above loan in the standalone financial statement of Jebra and Camel Limited. Already I have said. In consolidated financial statement, can you say entire transaction will be eliminated in CFS? Means financial asset, financial liability will be eliminated. Interest income, interest expense will be also eliminated. Also give journal entry under option number 2. In solution, I have given the similar journal entry. I have not given the journal entry for interest expense, interest income, that you can do by your own. Okay. Yes, sir. Also suggest the accounting treatment as per applicable Ind AS. If in future Camel Limited, now Camel Limited is subsidiary company, grant an interest free loan to Jebra Limited. If the Camel Limited grant an interest free loan to Jebra Limited, can I say in this case for Camel Limited it will be financial asset, and any difference will be regarded as deemed distribution of dividend, and that will be debited return earning. And for Jebra Limited, it will be financial liability, and the difference will be considered as dividend income that will be transferred to profit and loss account. Amount remains same. Amount of calculation will remain same. The solution is given. You can see the entire solution has been given. You can cross check the entire solution. For option number 2, you can see the 25 lakh is the face value. Market rate of interest 12%. Period is 4 years. Present value factor will be this amount. Therefore, the fair value loan will be this amount. And deemed equity or capital contribution, means investment in the equity instrument of subsidiary company, will be this amount. Journal entry, of course, you can see there is very simple. Okay. Yes, sir. Okay, sir. You can, of course, I hope this question you have managed it properly, means you'll get full marks if you have written correctly. There is some theoretical portion you write down correctly as per the requirement of ICAI. If you have not written as per the requirement of ICAI, they may deduct some marks. Now come to question number 2B. It is related to IND AS 1. Once again, similar question we have, and it was also manageable. Alpha Tech Limited, an Indian listed company, has availed on 1st July 2024 as short-term loan facility of 50 crore from XYZ Bank Limited, repayable on 30th June 2025. Repayable after balance sheet date on 30th June 2025. Alpha Tech Limited prepares financial statement as on 31st March of each year on 15th March. On 15th March means just before balance sheet date. Alpha Tech Limited and XYZ Bank Limited enter into a formal unconditional agreement to roll over the outstanding loan into a new long-term facility of 50 crore repayable on 30th June 2030. Means case agreement was entered before 31st March and it was converted into long-term loan, and therefore now it will be reclassified from current liability to non-current liability. Understood point. Discuss the classification of aforesaid loan in the balance sheet of Alpha Tech Limited as on 31st March 2025. Because the agreement was entered before 31st March, it will be now non-current liability. Okay. Will you answer to one change if the new agreement of Alpha Tech Limited with XYZ Limited was signed after 31st March but before the financial statement of Alpha Tech Limited were approved? Just try to understand it is a non-adjusting event as per the requirement of Ind AS 1 as well as per the requirement of Ind AS 10. So it will be current liability only in case number 2, in point number 2. Point number 3, will you answer to one change if the original loan from XYZ Bank Limited is paid on the due date, that is on 30th June 2025, out of the fund released on the same day by ABC Bank Limited under a new 5-year facility by ABC Bank Limited. The agreement with ABC Bank Limited is signed on 31st March 2025. Can you see in this case the existing loan will be current liability and new loan in the next year will be classified as what? Non-current liability, but existing loan will be considered as current liability only. Okay, sir. Point number 4, will you answer to point number 1 change if Alpha Limited is yet to sign any new agreement with any of the bank but has the intention and potential to refinance? Intention, potential to refinance is not at all relevant. It will be considered as current liability as on 31st March 2025. Justify, of course, you need to give reason. If you have given reason, you'll get 4 out of 4. It is a question of how many marks? 4 marks. I hope you understood. Answer you can read. Answer is given. You can read. Answer from here. Okay, sir. Now let us come to question number 3 in day 16. But before I start discussing about this question, I just want to share some information about this question. This question is totally a new question. You will not find this question in ICAI study material. You will not find this question in any faculty question bank. However, the same question was there in my 9th edition and all the previous edition question bank, which I have then removed from my next edition. Means in my 10th edition, you will not find this question in my question bank also. Now, of course, one question will be there in your mind. So, why you have removed this question from your question bank? The answer is the requirement of the student, demand of the student, because nowadays students don't want to study any question from any other sources. They want to focus only on those questions which has been given in ICAI study material. Right now, I just want to ask one question from you all. This question actually I have taken from CA Final old scheme of syllabus. Any question which was asked in CA Final old scheme of syllabus, whether it's relevant or not relevant, from my point of view, 100% relevant, because it is also a question of ICAI resource. And of course, in any exam, now under new scheme, the same question can be asked, and that was the reason I have included this question in my study material, which I have then removed as per the requirement, as per the demand of student. Because I need to also remain in the market. I need to also go as per the expectation, as per the demand of a student, because I need to stay in the market. Now, right now, I just want to ask one question from you all. Please reply in the comment box whether this type of questions should be included or should not be included in the question bank. Comment in the comment box, because let's see what is your reply to this. Whether you want this type of question, which is of course from ICAI resource. I'm not saying that I will take question from international book. I'm taking from CA Final old scheme of syllabus, and trust me, in previous attempt also they have taken some question from old scheme of syllabus. Now it is whatever consolidation question they are asking, they are taking from what? Old scheme of syllabus only. Not this attempt, but in the previous attempt, whatever question they have asked from consolidation, that has been taken from old scheme of syllabus. My question to all of you, should a faculty include this type of question in their question bank or not? Reply, and you need to say correctly whatever you feel. Okay, just try to, your reply is very important. Now let us discuss question number 3. However, I will say simple. If you know the concept, you can answer it. If you don't know the concept, of course, any question will be difficult in exam hall. Okay? Yes, sir. Kagaz Limited, Chennai purchased a modern offset manufacturing machine from a supplier at Mumbai for 20 lakh, being a maximum retail price, means invoice price, on the following terms and conditions. The supplier would buy back the existing machine of Kagaz Limited. The carrying value of existing machine is 6.6 lakh. So can you see it is non-monetary exchange? Whenever there is a non-monetary exchange, the cost price of PP acquired will be equal to, first preference will be given to fair value of asset given a plus minus cash adjustment, second preference will be fair value of asset received, and third preference will be carrying amount of asset given up plus minus cash adjustment. This point you know. The supplier would give a special discount of 5% on MRP. A cash payment of 15 lakh would be made by Kagaz Limited to the supplier. Means even though they acquired a old machine, a cash payment is there, 15 lakh cash payment is there. Okay. Kagaz Limited will purchase from local market all accessories required to operate a machine at 3 lakh, inclusive of all taxes. So there is some accessories that will be also capitalized. The supplier will, however, deliver free of cost certain heavy duty cable, etc., having an MRP of 2 lakh required to install and operate the machine. So they have got some free of cost, some cables. So free of cost, the consideration is 0 only. Yes, sir. Transit insurance will be borne by Kagaz Limited at 3% of MRP of the machine only. Of course, this will be also capitalized. Freight and other incidental of rupees 1 lakh is to be borne by Kagaz Limited. Of course, this will be also capitalized. Compute as per applicable India the cost price of new machine for Kagaz Limited, the profit or loss incurred by Kagaz Limited on buyback of arrangement. So buyback arrangement, there will be some gain or loss that we need to calculate. Gain or loss on sale of old machinery. Also pass journal entry in the books of Kagaz Limited. Ignore any impact of GST. GST impact need to be ignored. Super easy question. You can see similar question was there in my 8th edition question bank. If you read question 32, same to same question was there. As a proof, I have shown you. As a proof. However, the proof was not required. Chalega. Now what will be the answer? Answer is very easy. Correct. So what is given? We need to first calculate the cost price of machine. So what is the invoice price given? 20 lakh. There is a trade discount of 5%, 20 lakh will be 1 lakh. So this will be the purchase price. Purchase price is 90 lakh. On that we'll add accessories. 3 lakh will be added. And then heavy duty cable is there, that is free of cost. So 0 value. So that will be capitalized, but cost is 0. Transit insurance will be capitalized, that is 3% of MRP, that can be calculated 0.60. Correct. Then freight and incidental, that is 1 lakh, will be also capitalized. The total cost price of new machine will be 23.60. 23.60. Correct. Now can you see, we need to find out the gain or loss on buyback exchange. In that we need to find out carrying amount of old machine. The carrying amount of old machine is given how much? It is given 6.60. But now we need to find out the fair value of old machine. Fair value of old machine will be how much? What is the fair value of new machine? The fair value of new machine is 19 lakh after trade discount. Fair value of new machine 19 lakh. And how much cash payment? Cash payment is done 15 lakh. So can you say the fair value of old machine as on today will be how much? 19 minus 15. That will be fair value of what? Old machine. So 4 lakh become fair value of old machine. Please just try to understand what we have done. This is nothing but fair value of old machine plus cash payment, that is 15 lakh, that is 19 lakh. So we have applied IND AS 16 to find out the cost price of new machine only. Got this point? Yes, sir. The fair value of old machine is how much? 4 lakh. Now, if you know the fair value of old machine and carrying amount of old machine, so there is a loss. Loss is 2.60. That will be charged to profit and loss account as a expense. Okay. Now, what will be journal entry? Property, plant and equipment new. New will be how much? 23,60,000. We will de-recognize the old property, plant and equipment to property, plant and equipment old at their carrying amount 6,60,000. There's a loss on exchange. How much? 2,60,000. That is already calculated. That will be transferred to PL account. And how much cash payment we have done? Here is a cash payment was 15 lakh plus 3 lakh plus 0.6 plus 1. So 15 plus 3 plus 0.6 plus 1. It is 19.6. So 19,60,000 is cash payment. There is nothing but cash payment. You have written to bank account. This is the journal entry. Super easy question. The solution was not at all complicated. But what I just want to say, in exam hall, whenever there is a new question, it will take some time, and when you are taking some time, can I say, you will feel some stress. That's why if you have already done this question before your exam, can I say, it will be a bonus for you. I'm not saying that in the last revision you should do all the questions from other sources, but when you are doing the chapter for the first time, if you are taking more number of questions, that will give you better clarity about concept. That is my viewpoint, and therefore this question I have included in my question bank, but then I have deleted. I am waiting for your reply in the comment box. Okay. Now let us come to question number 3B. It is related to IND AS 12 expected question. Similar question we have in ICAI study matter. Same to same question we have. The financial statement of R Limited are prepared as on 31st March every year. The applicable income tax rate is 35%. Situation number 1, they have given R Limited hold 35% equity shares, means it is an associate, and it was acquired at 40 crore. Then they have given the carrying amount. The carrying amount has been calculated by applying equity method. As on 31st March 2024, the carrying amount was 70 crore. As on 31st March 2025, the carrying amount was 80 crore. Okay, yes, sir. Situation number 2, they given R Limited measures corporate office building by applying revaluation model. The building is revalued every year. On 31st March 2024, the carrying amount after revaluation was 50 crore and its tax base was 30 crore initially. Okay. During the year end, R Limited charged depreciation of 2.5 crore. To the statement of PL, means it is an accounting depreciation, but claimed a tax deduction of tax depreciation of 1.80. So 1.80 crore is a tax depreciation. On 31st March 2025, the building was revalued to 60 crore, revalued to 60 crore. So of course there was some revaluation gain also. Whenever there is a revaluation gain, there is some taxable temporary difference on which we need to recognize DTL, and that DTL will be created through OCI. In the tax jurisdiction in which this you can read, on the basis of the above information, you are required for both situations of R Limited to compute as per applicable IND AS the deferred tax asset and liability as on 31st March 2025 and the charge or credit relating to deferred tax to SOPL and other comprehensive income. The second part is more relevant. First part is very easy. Correct solution is given. Let us go to the solution directly. You can see situation number 1, investment in associate they have given. The carrying amount as on 31st March 2025 was 80 crore as per equity method and the tax base they have given 40 crore as per original cost. So 80 minus 40, taxable temporary difference of 40 crore. Therefore, we need to recognize deferred tax liability, and deferred tax liability will be 14 crore. That is 35% of 40 crore. Super easy. Okay. 40 into 35% is equal to 14 crore. Now, can you see we need to also find out charge to statement of PL. So you can see the opening balance, it was carrying amount 70 crore and the tax base was 40 crore. So initial taxable temporary difference was 30 crore and the closing taxable temporary difference was 40 crore. It means how much taxable temporary difference increases, that is 10 crore. So 10 crore into 35%, 3.5 crore will be charged to profit and loss account. Will be charged to profit and loss account. Means what will be your journal entry? Journal entry will be deferred tax expense account debit to deferred tax liability for this, and deferred tax expense will be charged to profit and loss account. Okay, sir. That is only given. Now, situation number 2 about the office building, that there is a revaluation. So you can see carrying amount as on 31st March 2025 is given 60 crore and 60 crore is given a tax base. Opening tax base was 30 crore. There was 1.8 crore tax depreciation and closing tax base will be 30 minus 1.0, that is 28.20. So 60 minus 28.0, that will be 31.80. 1 second, there will be taxable temporary difference because in this case carrying amount is more than tax base. So taxable temporary difference. So DTL will be how much? 31.80 into 35%, that is 11.13 crore will be DTL. Now in this case, what will be charged or credit for the year. So you just try to understand what was the opening DTL. Opening DTL will be on 50 crore minus tax base. 50 crore was the carrying amount, tax base was 30 crore. It means 35% of 20 crore, that is 7 crore. 7 crore was the opening DTL. Opening DTL. What is the total increase in DTL? You can see the 11.13 minus 7, that will 4.13 crore. That is the total increase in DTL. Now we need to find out what is the effect of this total increase in DTL. So allocation of this will be how much will be transferred to PL, that we need to understand. That will be due to depreciation. So to profit and loss account, how much will be allocated? What is the accounting depreciation? 2.5, and what is the tax depreciation? 1.80. This will result in deduction of taxable temporary difference. Means this will be credited to profit and loss account. This will be credited to profit and loss account. So if the deferred tax liability will decrease, so deferred tax liability will decrease. So that is nothing but deferred tax income. So how much deferred tax credit? It will be 0. The difference is 0.70 into 35%. That will be 0.245 crore. And can I say due to revaluation gain? What was the revaluation gain? What was the revaluation gain amount? So carrying amount was 50 minus 2.5 accounting depreciation, that was 47.50 before revaluation, and after revaluation it was 60 crore. So there is a revaluation gain of 12.50. On that, DTL will increase, means on that DTL will be created. So DTL will be how much? 12.50 into 35%, that is 4.375. So this will be actually debited to OCI. Your journal entry what? OCI revaluation surplus to DTL 4.375. You can see 4.375 minus what? Minus 0.245. 4.375 minus 0.245 is nothing but how much? Sorry, 4.375 minus 0.245. It is nothing but 4.13, which was the actual increase in the DTL. Understood? So this is the solution given. Same to same we have in our study material. I hope this was manageable. Okay, sir. Good. Yes, sir. Now let us do question number 4A. This question, once again, very simple question, similar question we have in ICAI study material. Already past attempt also they have asked this type of question related to IND AS 105. You Limited had purchased a production plant of 9 lakh on 1st April 2022. The useful life of the plant is 9 years and is depreciated on a straight line method with nil residual value on 1st April 2024, means after 2 years. You Limited temporarily stopped using the production plant as demand has declined. However, the plant is maintained in a workable condition. It will be used in future when the demand peaks. Means can I say it is actually not it should not be classified as held for sale, correct? Nor it is an abandoned asset. It is not an abandoned asset also. The accountant of U Limited decided to treat the plant as held for sale until the demand peak and accordingly measure the plant at lower of carrying amount and fair value less cost to sell. Can I say wrong treatment? Accountant has also stopped charging the depreciation for the rest of the period considering the plant as held for sale. This is also wrong treatment. The fair value less cost to sell on 1st April 2024 means as per their classification date. And on 31st March 2025 is 6 lakh and 5 lakh respectively. The accountant undertook the following working. You can see purchase price was 9 lakh. They have calculated accumulated depreciation of 2 years. Carrying amount becomes 7 lakh. Fair value as on 1st April was 6 lakh. So the value on this date, on their classification date was 6 lakh. However, it was shown as asset classified as held for sale as on year end at what? 5 lakh. 5 lakh was the fair value less cost to sale on the reporting date. Okay, sir. Discuss the above accounting treatment of the accountant as per IND AS 105 and as per IND AS 16. Actually, I will say this is a question of analysis of financial statement. We need to analyze it. We need to write down as per applicable IND AS. So some theoretical portion is also required. In case you are not in agreement with the accountant, suggest the correct treatment, give necessary working. It is a question of how many marks. You can 6 marks. So of course you need to also think about from time management point of view that how much you should write, how much you should not write. Correct now means what you should write and what you should not write. Okay, now I will say question is easy, you can understand by your own. Analysis given, you just read it. From my point of view, as per the working note is required, reading part you do. 9 lakh is what? The original cost. 9 year is what? The useful life. 9 year was the useful life. Yes sir. So can I say the annual depreciation 1 lakh. So can I say we need to charge depreciation for current year. So current year depreciation 1 lakh. So accumulated depreciation will be 3 lakh. So it will be 9 lakh means already 2 lakh depreciation has been charged. So 7 lakh minus 1 lakh. So 6 lakh will be the carrying amount. But can I say it was idle from active use and therefore it will be indicator of impairment. Therefore impairment testing will be done. Whenever impairment testing is done as per the indicator, impairment testing is done at the end of the year. So at the end of the year, they have given fair value less cost to sale. They have not given recover. They have not given value in use. So we'll ignore that. We'll take the fair value less cost to sale. So fair value less cost to sale on the assumption that fair value less cost to sell is more than what value in use, that assumption will take, or we need to assume that value in use is not determinable. Okay, sir. The recoverable amount is 5 lakh, carrying amount is 6 lakh. So there is an impairment loss of 1 lakh. The impairment loss, this is as per IND AS 36, not as per IND AS 105. And now the presentation in the balance sheet, it will not be classified as held for sale. Therefore, the PP will be shown under non-current asset at 5 lakh, and this 1 lakh will be shown as impairment loss in SOPL. Okay, sir. Good question. Chalega. I think 1 second manageable. Most of you have done correct only. Okay, done. Now let us start with the question number 4B. This question related to IND AS 20. I don't understand why they ask this type of question at CA final level. This type of question they should ask at CA inter level, and will trust me, this question have been asked for 8 marks. Means they have given 4 situations and you will get 8 marks. Super easy. Trust me, if the same question they will ask a CA internal, they will ask this question for 4 marks. I know that you know the answer of this. No discussion required. You can go through the solution, whatever has been given in my PDF. I will not discuss this question. You can understand by your own. Okay, but one thing, when they have given 8 marks, if you are not writing properly, they will not give full marks. So in this, writing as per the requirement of IND AS 20, that is relevant. If you want full marks, 8 out of 8. Okay, sir? Yes, sir. Coming to question of 5A related to IND AS 15. Good question. Once again, new question, but simple, super easy question. Grant Limited enter into a contract with a customer to sell a machinery. The machinery is transferred to the customer when the contract is signed. The price as per the contract is 10 lakh plus contractual rate of interest at 8% per annum, payable in 5 equal installment of 2,50,438. So you can see 2,50,438 into 5. So if you minus 10 lakh, so can you say 2,50,190 will be the interest as per the contractual rate of interest, No down payment is envisaged for the sale. Grant Limited avail loan at a rate of 10% per annum from his banker for similar back-to-back transaction. It means they have given incremental borrowing rate, I can say. Statutory auditor of the company has advised Grant Limited to recognize the transaction price of the machinery after discounting installment payment at a rate of 10% per annum, and observe that 8% contractual rate of interest is significantly lower than 10% interest rate at which the company avails the loan from its banker to fund such transactions. Determine the transaction price of the machinery if the company accept the suggestion of statutory auditor of the company. So if you accept the suggestion of statutory auditor, so it means you need to find out the present value of all these future installment at 10%. That will be what? The transaction price that you can calculate very easy. Means the point number A to super easy. So for point number A, what we have done, annual installment is this. Number of year is 5. Discount rate at the rate of 10%. Present value annuity factor will be 3.79. Multiply by this. So this 9,49,160 will be the transaction price as per the suggestion given by statutory auditor. Okay, sir. Then what is the next point? Should Grant Limited accept the offer of the customer where the customer want to cancel the contract for payment in installment and offer a cash price of 9.65 lakh? Means they just want to compare the cash price transaction with the installment transaction. Can I say it is a decision making question, not a question of FR, not a question of IND AS 15. I have not understood why they have asked this part, but chalo, theek hai, okay. Whatever ICAI will ask, will answer. In this case, you need to compare the cash payment immediately with the installment payment. So can I say in this, you can see what is the customer offer, 9,65,000. What was the implied cash selling price, that is 9,49,160, whatever we have calculated in our previous part. And if you compare, so if the customer is offering 9,65,000 cash payment immediately, that is what favorable option, and therefore we should always accept this. This is the solution. I hope super easy. But why they have asked this question, I have not understood. Okay, so you can answer it. The decision making is given. But what I just want to say, this is not a question of IND AS 15. Now come to the next point, next question, that is 5B. It is a question of IND AS 101. I always say this type of small chapter is very important from examination point of view, because whatever question they have asked, that was super expected. But if you have not revised this chapter, you will not be able to attempt it. From my point of view, if you have revised this was super easy. But if you have not revised it, quite possible you have forgotten what to write, what not to write. Okay, sir. Moose Limited has decided to present its first financial under Ind AS for the year ended 31st March 2025. The date of transition will be the previous year opening date, that is 1 April 2023. The following adjustments were made by Moose Limited upon transition to Ind AS. The company opted to fair value its land as on the date of transition. The fair value is given 12 crore and the carrying amount is given on the date of transition 6 crore. So of course there is an increase and this increase will be transferred retained earning. However, if the subsequent year they will opt for revaluation model, then of course increase will be transferred to revaluation surplus. But if question is silent, we'll always assume that they will opt for cost model and this 6 crore will be transferred to retained earning. The company had recognized a provision for proposed dividend of 40 lakh and related dividend distribution tax of 12 lakh for the year ended 31st March 2023. This is a question which they have copied paste a past year attempt. However, now there is no dividend distribution tax. I don't understand when they copy paste any question, they should modify the question, but we need to accept it. So guys, we need to write back because now as per Ind AS 10, we can't recognize what our proposed dividend and any dividend distribution tax. So once again, when you write back this proposed dividend, so your retained earning will increase by how much? 52 lakhs, means 0.52 crore. The company decided to show the investment in equity shares at fair value on the date of transition. The increase on account of fair valuation of shares is 50 lakh. Once again, the retained earning will increase by 0.5 crore. Okay. The company has an equity share capital of 100 crore and redeemable preference share capital of 25 crore. The reserve and surplus as on 1st April 2023 is given 110 crore. Out of that, 60 crore is general reserve and 10 crore is capital reserve, and the balance will be retained earning. The company identified the preference shares by in the nature of financial liability. Even though not given is given redeemable, it will be classified as financial liability. Compute the balance of total equity, that is equity share capital and other equity as on the date of transition, and we need to show the reconciliation of equity as per AS with equity as per Ind AS. Very simple. So what you need to do, that your equity share capital how much? 100 crore. Then your general reserve is how much? 60 crore. Your capital reserve will be how much? 10 crore. And the balance 110 minus 70 means 40 crore will be your retained earning. Then your retained earning will increase by how much? 6 crore. Then for proposed dividend, your retained earning will increase by 0.52 crore. And for investment, your retained earning will increase by how much? 0.50 crore. 0.50 crore. Okay, this will be equity as per Ind AS. This will be equity as per Ind AS. So already we have done the solution. Let's see what they have given. So you can same thing, 100 crore equity share capital, 60 crore general reserve, capital reserve 10 crore, and this is the balance of retained earning. Balance of retained earning will be 47.02. The total other equity will be 117.02, and total equity as per Ind AS will be 217.02. Now we need to do reconciliation. The first we need to find out equity as per accounting standard, that is 100 crore, 25 crore, redeemable preference share capital 125, share capital 110, reserve and surplus 235 is the equity as per AS. The reconciliation, first we'll do reclassification of preference share capital because now it is not an equity, it will be financial liability minus 25. Then proposed dividend is written back, therefore your retained earning will increase by 0.52, and due to revaluation of land and the revaluation of investment, your retained earning will increase by 6.50. That will be the total. This will be equity as per Ind AS. Super easy question. But once again, whether you have revised or you have not revised, that is a point of question. Okay, now let us come to the next question, that is 5C. It is a theoretical question. They have given two questions in this, either this or this you need to attempt. Let us read what is the question. In view of increasing inflow and foreign capital and the resultant complexities in the financial instrument and transaction, critically examine the necessity of introduction of Ind AS in place of erstwhile accounting standard. Means you need to write down the benefit of Ind AS. Theoretical question. If you want answer of this, I can give you, but it is not given the PDF. If you want, just comment me, I'll just give the theoretical answer of this also. Then point number C, I don't understand why they ask this question in FR. Once again, I am surprised. Discuss the key relevant provision of Companies Act 2013 with reference to Ind AS and the matter to be included in the report of Board of Directors and report of statutory auditor of the company in respect of compliance of Ind AS as notified by central government under section 133 of Companies Act. But chalo, theek hai. They are asking this type of question, we need to answer it. If you want answer, just comment me in the comment box. I'll give the answer for this. In the PDF, it is not included, but you can find in the FR book. Okay, means FR ICAI study material. We don't expect this type of question in exam. So this was totally unexpected question from my point of view. Okay, now let us come to question number 6. This is a question of professional and ethical duties of chartered accountant. Easy but new questions. If you want, I will read. So let us read. You are a chartered accountant, have recently been appointed as a new CFO at Digitization Solution Limited, a listed company in the hardware distributor sector. While reviewing the financial statement for financial year before submitting the same for the audit, you identify the following issues. So, as a chartered accountant, you are right now employed. Channel staffing and premature revenue recognition. The product worth rupees 18 crore were shipped to distributor on 38 March, but there were no confirmed purchase order. This transaction have been recorded as revenue for Q4, not correct because control has not been transferred. Distributor were offered extended credit term for 180 days and the right of return for unsold goods within 60 days. Means you need to give accounting treatment as per IND AS 15. Deferred recognition of marketing expense, we can't defer it as per the requirement of IND AS 36. A 4 crore marketing campaign conducted during Q4 was capitalized as deferred revenue expenditure instead of being expensed with the intent of inflating the profit. Okay. Under statement of warranty provision, historically the company incurred warranty claim equal to 4% of sale, but in the financial year 24-25, management has only provisioned 1.5%, citing the need of smoothing earning. Once again, there is some misstatement is there. The management company is under pressure to meet quarterly earning target due to risk of the credit rating downgrade and to meet the expectation of institutional investors. Discuss and analyze the implication of accepting this treatment with reference to ICAI Code of Ethics. The solution has been given. You can read the solution. Has been drafted very properly. You can just go through the entire question. Okay, I am not reading the solution. Okay, coming to question 6b, it is a question of IND AS 19. Once again, similar question we have in ICAI study material. Very simple question. You can do it by roll. And this type of questions are also expected. Crystal People Limited has a total headcount of around 1000 employees during the financial year 24-25. As per the company leave policy, employees are entitled to 35 days of privilege leave, 15 days of sick leave, and 10 days of casual leave each year. Out of total PL and SL, only 10 days of PL and 5 days of SL can be carried forward to the next year. So only 10 days of PL and 5 days of SL can be carried forward. One thing is clear, that 10 days of casual leave cannot be carried forward. It is actually not compensating, therefore will not recognize any provision for 10 days of casual leave. Okay, based on the past trend, means as per the past experience, it has been observed that 200 employees are likely to take 5 days of PL and 2 days of SL. Means this is the probability of availment. So you need to create provision based on the probability of availment, while the remaining 800 employees are expected to avail 10 days of PL and 5 days of SL. So it is actually how much they have carried forward, that is the only the probability of availment. Means can you say for 200 employee it is PL, it is SL. So for 200 employee, how many is likely to be availed? That is 5 days, 5 days of PL and 2 days of SL. For 800 employee, what is the probability of availment? 10 days of PL and 5 days of SL. So can you say for PL we can recognize for 200 employees 5 days and for 800 employees 10 days. And for SL we can recognize for 200 employees 2 days and 800 employees 5 days liability. Okay sir, yes sir. The company has been earning profit consistently since 2010 and in the financial year 24-25 decided to distribute profit to its employee at a rate of 4% annual profit. However, due to employee turnover, the expected payout is estimated to be 3.5% annual profit. The company has earned a profit of 5000 crore. So it need to be, the provision should be created based on expectation. Therefore, we'll create a provision for this particular expense, that is 3.5% of 5000 crore. Additionally, Crystal People Limited has a post-employment benefit plan which has been classified defined contribution plan with contribution amounting to 250 crore due within 12 months from the end of accounting period. Means the amount is payable within 12 months. Out of this, the company has already paid 50 crore during the financial year. It means we need to recognize an expense of 250 crore and already 50 crore has been paid. We need to recognize the liability of 200 crore for defined contribution plan. This is the only answer. Solution is given. You can just go through the solution. Coming to the last question, that is question number 6C. It is a good question. Thora sa modified question, similar question we have, but they have modified. Thora sa. You are in the process determining it is a question of IND AS 113. Valuation of K Limited, you have decided to adopt two valuation approach, namely market approach and income approach. Under the market approach, the enterprise value of the company is to compute it using EV by EBITDA multiple. Means whatever EV of the company that will multiply by this will get the enterprise valuation. Under the income approach, the EV has already been determined based on the company's projected cash flow. Means they have already determined based on income approach. Historically, the higher of two valuations were selected as the final value. However, based on a discussion with your partner, you are now been requested to assign equal weight. Equal means 50% to income approach and 50% to market approach. Okay. The relevant details has been given. EBITDA trailing 12 month is 620 crore. EB by EBITDA multiple 8.5x, 8.5. EV as per income approach already given means market approach can I say it will be 620 multiplied by 8.5. This will be as per market approach. Debt obligation is this much surplus cash and cash equivalent, fair value of surplus asset and liability, the number of shares they have given this. You are required to compute a fair value per share of ICAI Limited based on the above input, considering 5% liquidity discount and 5% discount for NCI. So this much discount will get, first will calculate value per share minus 5% minus 5% in order to arrive the final fair value per share from the investor's perspective. Means the answer already. Let's see what is the answer given. You can see first we need to calculate EV under market approach. The formula is what? EV is equal to EBITDA multiplied by EB by EBITDA. This is the formula. So they have given 620 multiplied by 8.5. So 5270 will be EV as per market approach. Got this point? Step number 2, compute and weighted average enterprise value. So EV as per income approach is this much already given. EV as per market approach we have calculated. So this into 50%, this into 50% will find out the EV as a weighted average. So that will be 4985.55. From this we'll deduct the debt, will add surplus cash, will add surplus asset. Whatever the total will come, that will be the total equity value divided by number of shares. The number of shares whatever is given, that will be divided, and this will be value per share. Now whatever value per share we have calculated, we'll deduct 5% for NCI discount, 5% for liquidity discount. After deducting 10%, we are getting 416.01. This is the fair value per share. Then entire paper discussion is over. Means I have done the detailed discussion of each and every question, and also entire solution has been drafted in PDF, which you can download from my Telegram channel or WhatsApp channel. Do join that channel, already have informed you. I hope you have liked this video. Do like this video and share this video with all your friends. All the best for your exam result. Love you all. Bye bye.